So this week's video is going to be a precursor to next week's video, which is all going to be on comparing mutual funds and index funds. So for now, what I wanted to do for this week was focus on how index funds actually and mutual funds make money and subsequently make you money. So there's two real strategies. One is income and the other one is growth. So let's head over to my office and we'll get started. To illustrate the difference between growth and income, I'm going to use a couple different stocks just to make my point. So to think about growth, I'm going to use the company Apple. Now, Apple is a company that's constantly innovating and making new products. They're also constantly looking at different machining processes and different materials. So they're doing a lot of research and development into their upcoming products and services. So anytime that Apple releases a new product, say a new iPad, iPod, iPiss, whatever, they're going to take the profits from that product and any development that they did with it and pump it back into the actual company for more research. This in turn allows for the company to grow. This growth in capital or business is known as capital growth, and from it produces what are called capital gains. So for example, as of right now, Apple stock is sitting at around $264 a share. And let's say they go ahead and release some new product, or for whatever reason, their stock grows to $280 a share in the next few months. That $16 is considered capital gains. And the value that you would gain as an investor would go up by $16 per share that you owned in Apple. And likewise, if you owned shares of an index fund where Apple was a part of that and a bunch of other companies that had the same type of capital appreciation and gain capital gains, as the index fund grows, you would gain value in your money by the index fund growing in capital gains. Now let's contrast that strategy with another company like Coca-Cola. Now, Coca-Cola has been around since 1892, and with the exception of, say, maybe a couple different flavors, like the cherry, the vanilla orange, or whatever, they're going to probably come up with a peanut flavor at this point. With the exception of different flavors and maybe some modifications to the formula at the beginning and the new bottle designs, Coca-Cola has been pretty stationary and been pretty consistent throughout the last few hundred years that they've been in business. So this means that a good portion of the profits that Coca-Cola makes don't have to be reinvested back into the company. So in order to keep investors interested, what Coca-Cola does is they'll take a portion of their actual profits and give it back to the investors as income. And this income is called a dividend. And if you were to put it into an index fund or mutual fund that also has companies that do the exact same thing, this index fund in turn will pay you dividends, usually on a quarterly basis. Now, one real quick final way that you can make money using index funds and mutual funds is, let's say I as a mutual fund manager had shares of Apple, and let's say I bought it at $264 per share, and then let's say it grew to $280. So that would be $16 worth of capital gains. Now, if I left this inside the fund, it would remain as $16 in capital gains. However, let's say I took those Apple shares and sold them and actually made the $16 in the actual capital gains. Now, me as a mutual fund manager, I'm going to take a little bit out for my fees and some for taxes, leaving the remaining capital gains actualization. Now, because you were invested in the index fund, you would get this $10 as what's called a capital gains distribution, and it also counts as income. Whether or not you reinvest dividends or the actual distributions, or whether or not you just let a index fund or the investment grow normally, those individual little contributions are going to compound over time, and that's what's known as compound interest. So what actually is compound interest? This is my financial compound interest model for personal finance. And as you can see, I have just a bag of coins right up in here, and it's a giant pendulum. Now watch what happens as I make tiny little additions at just the right time. So you can see by the swing of this, it's going much larger than it was just before. And all I was doing was just making tiny little taps to it. This is how compound interest generally works. And like compound interest, the fees that you're going to end up occurring on index funds do this. where it gradually reduces the amount that you have. This is why you need to continually be adding in a greater amount than what the actual fund will be taking away in fees. But this is just a physical model to basically demonstrate how tiny little additions over time create large swings after a while. So I have here a bullseye that I printed out, and I'm going to tape it to that door. Now I'm going to take this pen and I'm going to throw it at that bullseye. I'm going to see how good of a shot I really am. Now I know this thing is not aerodynamic and it's going to want to flip, but let's see what I can do. I got one. I'll go ahead and try a couple more. So here's how I did. Not the greatest. I'm not the greatest pen thrower, but that was done on purpose. So what I'm going to do is draw a circle around the area, or basically make a little circle around the largest points on the outside, so you can kind of get an idea of the area that I covered with this. So you can probably see that green line that I put in there. Now what I'm going to do is measure the diameter of that green line. So I wrote it up here that I have that green circle and its diameter is about 6.25 inches across. This diameter and this circle pretty much indicates the amount of deviation from the center, or how much spread I had when I was throwing my darts or pens. Now let's add a hypothetical red player who's much better at throwing pens. Here's the red player's marks, and now I'll draw a circle around that. So this circle encapsulates all of the red player's marks. Now let me take a measurement of that circle diameter. That circle is about 2 inches in diameter. Another way of looking at this is that the red player's spread, or the diameter of his circle that enclosed all of his marks, is much smaller than my spread. So the deviation, or the spread, is another way of talking about the diameter of the circle that encloses both the red players and my marks. Now the red player was more consistent. In other words, he was able to hit near around the same area every single time, whereas my marks, that was pretty inconsistent. However, I did manage to hit a bullseye, whereas the red player didn't. So now the question becomes this. Let's say you were a betting person and you were going to bet either on me or on the red player. Who would you bet to win after, say, 50 throws, 100 throws, 200 throws, 1,000 throws? I just added a scoring system right here. So a bullseye is worth 10, the next ring out is worth 8, the next ring out is worth 6, and the next one is 4. So again, how would you be able to determine which of us, the red player or me, was actually better at this game? And here's where the first problem really starts to show its head. You could count up the number of darts and how many points we each got just by adding up how many times we hit the certain rings. But if we were to predict which one of us was going to do well in the future, how would you know which one of us would be better? I mean, I did end up managing to hit a couple of 10s, or 110, and a few 8s, whereas the red player pretty much stayed on the 6. But I also got a few on the outside as well, and I was pretty inconsistent all over the place. So what we need is some kind of a scoring metric that will allow us to differentiate between the red players and my abilities. So what we want is some number that kind of defines how good of a player we are. One way of comparing myself to the red player is to evaluate what our individual scores are, say after 100 or 200, whatever, 500 throws, and divide that by whatever number we decide as the spread. This means that the number right here that we're looking at will go up as we make a higher score, but also will go up if we reduce the spread. Another name for this spread is called volatility. Now we have a way of comparing the red player and myself, because we're not just looking at the score, we're not just looking at how many points we accumulate, we're looking at how consistently we are able to maintain that particular point average. For example, let's say I made 22 points and the spread was 30. 30 comes from the fact that this is an area of a circle, so when you run the math on that, it's about 30. So my number that defines how good I am would be 0.73. Now let's do this for the red player. So let's say that player red, or Pred, managed to score 4 points, a lot less than the number of points that I scored, but his spread was a lot smaller than mine. That means the red player's score was 1.33. And in this case, whoever has the bigger number would be known as the better player. So if you were going to bet on one of us, it would be better to bet on player red, because consistently over time, I'm going to end up losing with the larger, more volatile strikes. Whereas the red player, even though he made fewer points, would actually, due to his consistency, would end up with more returns over the longer period of time. And this is exactly how mutual funds and index funds can be compared across the board. It's not enough to just look at the returns, say 7%, 8%. You have to look at how consistently that particular fund managed to produce those returns. And this is something we're going to look at next week when I go through a video on on how to choose the different mutual funds. So there's a ratio for all these different types of funds, and it's basically the return, or the score, divided by the volatility, or the spread of how inconsistent or consistent that fund managed to maintain that return. And the specific type of ratio that we're going to be looking at next week is called the Sharpe ratio. Next week, I'm going to walk you through step-by-step on how I choose mutual funds. I'm going to be using the same metrics that I went over these last several videos, so it's going to be all on income and growth, the expenses, the volatility, and everything else that is going to be needed in order to fully understand how all the index funds and mutual funds compare and contrast to one another. So anyways, hope you guys have a really amazing Thanksgiving, and be safe, and I will talk with you guys later.